Do you think simply opening a self-directed IRA is enough? Well, it's not. That's where most investors lose the game because they stop there. And we're going to talk about that today on the Furlo Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing, even with a self-directed IRA account. And our mission is to equip people to invest wisely in both property and people so that together we can build wealth, ideally tax-free, while improving housing. I'm James, and this is my wife, Jessie.
Nice. I was thinking, I don't know, you were just talking about money and saving, and it made me think of inflation. And I had this conversation, so our son lost a tooth recently.
Ah, yes.
And we were negotiating, like how much do you think the tooth fairy should give you? That sort of thing.
Oh, yeah.
He was like, I definitely deserve $10.
$10.
Oh, yeah, because it was wiggly on a camping trip, which was caused turmai. And so there was displeasure.
Back pay.
Yeah. So I owed him. I was just like, I don't know about that, man. So I gave him $3. But even still, I'm like, $3? Dang. I used to get like a quarter. Like, come on, teeth are not that expensive.
No, they're not.
I mean,
they grow back.
They are. Because orthodontia and all the things.
Oh my gosh.
But
yeah.
Anyways, that's why you save.
That's why you save.
Invest, I guess.
Yeah, ideally in a tax-free vehicle to make that happen. Yeah, and I do want to talk about self-directed IRAs. And I know we talked about it like once briefly a long time ago, but I think it's worth revisiting and like how do you take it to that next level? Because most people, right, they get into a self-directed because they're just tired of like the ups and downs of the stock market, being locked in with some sort of index fund or whatever. They want to take a little bit more control and at the very least just make it more interesting.
Yeah.
And self-directed is relatively easy to get started, to be honest, but there's things you can do to really kind of take it to the next level. And so I want to talk about that. And I got a lot of these ideas. I'm a weirdo and I subscribe to different IRA and self-directed IRA like websites and blogs and stuff. Yeah. And so I got this one from one of them and pieced together a few of them. Just kind of like, all right, here's how you take it to the next step. Yeah. And so the big thing that differentiates people, and we'll get into more specifics of this, is to do well with a self-directed IRA, it's not enough just to go off and now buy assets. You actually want to have a strategy with how you're using it.
Okay. So I feel like you need to take a step back. If anybody missed the previous one, just give a rundown.
I'm sure everyone caught it. We're good.
Just saying.
Yeah.
Give us a brief description of what is a self-directed IRA.
Yeah, so it's kind of self-describes, right? So you are able to say, I want to buy this thing, and it's not necessarily stock market related. It could be all sorts of stuff. It can be real estates, it can be businesses, it can be commodities, it can be all sorts of stuff. Actually the list of what it can invest in is smaller than the list of things that it can, that it can't invest in is smaller than the things that it can invest in. Like you can't do art for some reason, or jewelry. Yeah, there's a few other things there, but the general idea is you can direct it. And the big one is it lets you invest in both real estate and businesses.
Cool.
That's like what most people
So
do
it's like another savings account in the sense that you open it, you put money into it each year. There's limits as to what you can put in. But the benefit is that you get to decide where the money's being invested.
Correct. Yes. Cool. It's like a retirement account. It's a retirement account is what it is. Yeah. But not all retirement accounts are created equal. So the very first thing that people do is they prioritize the Roth retirement account over the standard. So the Roth grows tax-free. So you pay taxes on money you put in, but whatever the growth is totally tax-free.
Okay.
So
essentially you don't get taxed when you take it out.
Correct. Yeah. Yes. As opposed to the standard, you put money in tax-free, but once it's grown and big, then you get taxed on the other side of it. And furthermore, there are minimum distribution requirements in the normal retirement account. And that's because government, they want their tax money.
Yeah.
Whereas with the IRA, with a Roth, there are no minimums, and you can pass it down to heirs, which are also, by the way, tax-free. And so super powerful. So what people do is let's say you have like a normal IRA And even if you convert it into a self-directed one, you then convert that into a Roth, which means you pay the taxes in the moment.
Okay.
Right? So if you've got $100,000 and you want to roll that in, you do it, great. It's now as if you had $100,000 worth of income that you got to pay taxes on. Mm-hmm. And the wealthy do it. They don't care. They're like, yep, because I know they're not playing for, let's say, 2025. They're playing for 2045, 2055, way down the line. So they would much rather do stuff with a Roth. And I think that's one that, it's kind of a big one.
So the returns on this particular investment type or this particular account, I guess is the word for it. They're not dependent on like stock market returns because that's not where you're investing. They're dependent on whatever you're investing in. So if real estate is getting a 16% return, that's the return that you're getting?
Yeah.
Okay. Which that kind of makes sense that it's a benefit and
and by the way, you can invest in the stock market. You're not allowed to.
Sure.
You can still invest in index funds. You can still invest in specific stocks.
So is the downside then that you have to do a little bit more work up front to know what you're investing in? Or can you be like, I have a self-directed IRA that I'm giving to this broker or this person and they're going to manage it for me? That's not a thing.
That's a good question. I don't know the answer to that. I don't think it's a thing. It might be a thing, but most people who are self-directing it are because they want to
direct it
with themselves.
Sure.
I could see in theory where they could say, "Hey, I want to self-direct it, and I have a financial manager, and they're finding stuff for me." I don't see that happening. Honestly, if you are busy, here's what I would say: if you're too busy to do the work yourself to find the investments, dude, just keep it in a normal account, invest in a stock market. Why add all the complication? It's not worth it.
You'll get plenty of return. You'll be fine. It's low risk.
Yes. Yeah. If you're not willing to get the financial IQ to find it, don't do it. Yeah.
That makes sense.
Yeah. All right. Next one is they stack strategies, not just assets. Okay. So again, you might have what's like, oh, I'm investing here, investing here, investing here. Instead, what those 1%ers do, the really, the wealthy folks, is they stack things. So like, for example, they don't just open one up, but they open one up with checkbook control. So what that does is it essentially, if you don't have it, so the normal process is you open up an account, you find an investment, you go, awesome, I want to invest. And then you call up that custodian, that company who you open the self-directed IRA with, and you go, hey guys, I want to buy this thing. Can you send in the money, please? And they go, sure, fill out this form. There's a little bit of a fees, whatever, blah, blah, blah. Like it's done. Or what you do is you open one up that has checkbook control, and instead of the funds sitting in that custodian account, it sits in a checking account that you have a checkbook for.
Weird.
And then
you don't even have to go through a third party to
there's no paperwork, there's no expense, it's just go. Now, there's also no double checking that you're doing everything right. So
once you send your check, that is it.
Yeah, and there are certain transactions, and that'll actually be the next one that we'll talk about, that you should not, never do.
Really?
And if you have a custodian acting as an intermediary, they'll stop you. They go,
they'll be like,
you can't
don't do this.
But if you have checkbook control, you can move super fast because it's literally as fast as writing a check. But you could potentially do a prohibitive transaction.
Okay, now I'm intrigued. What are these no-nos?
Yeah, we'll get there. To do? So other strategies that you can stack on top of that is like you can consider opening up a solo 401k instead of an IRA because there's higher balances. There's other benefits that you can get to it, assuming that you qualify for it. Yeah. One of the nice parts about that is you eliminate the UDFI, which is a type of tax that gets applied to IRAs. So there's benefits there. They can also combine accounts. So you might have an HSA, which you make self-directed. Yeah. You might have a Roth IRA that you make self-directed. And you might have a solo 401k that you make self-directed. And then what you can do is you can have all three accounts invest in a thing.
That's interesting.
Yeah, so you don't necessarily have to
So it's not necessarily a self-directed IRA is not the only thing that can be self-directed.
Correct. Pretty much any type of retirement account can be self-directed.
How do you convert it?
So if you have whatever it's with, you then call up one of these custodians. UDirect is one who I like, but there's a bunch of them out there. and you go, hey, I want to convert this thing. You go, cool, there's some paperwork. And it's as if you're rolling over to,
you like transfer
it's
funds.
as if you were transferring from like, say, Charles Schwab to Vanguard. It's
interesting.
There's paperwork.
Yeah.
And you just go through it and they work you all through it.
You essentially just move your money to a different spot.
Yep. Other thing they'll do is they'll also pool their money with other things, like doing it in a syndication or something like that, where they can actually go after bigger deals, where they potentially get bigger returns, and they don't have to worry about doing all the management stuff for it, which can cause some potential issues. Which is, by the way, the next one is they avoid prohibitive transactions like the plague. Okay, so the number one rule is you cannot personally benefit from the retirement account's investment or anyone related to you, and vice versa.
Seems kind of counter to what you're trying to do.
Well, no, like for example, my retirement account cannot buy a house and then I rent it from it.
Oh, you can't get like material benefits. Well,
my retirement,
you can get financial like pay.
What do you mean?
Well, like if you invest in the property and then they sell it and you get paid, like.
What do you mean they sell it?
Well, like you give your money to an investor. The investor gets a return and then they pay you.
No, they don't pay me. They pay the retirement account.
Oh, you don't get.
I don't see anything, and then I just do a distribution from the retirement account.
Okay. So the money just goes back and forth into the retirement account.
But again, so let's go with this example. So one of the things I can't do is say, oh, my retirement account's going to buy this property, and then I'm going to manage the property, thereby saving money on a property manager.
Right.
Now I'm benefiting.
But because you're getting paid to manage.
Or actually, in that case, it's the retirement account is benefiting, right? Because it doesn't have this expense anymore because it's getting it from me. Or if I do work on it, like, I'm going to replace the roof, and I'm just going to pay myself for fixing the roof. No go. Can't pay me. I can't even say, well, I'll do the work for free. Again, no go, because now that's a benefit to the retirement account because it would have had this expense that I just saved it. I essentially donated my time.
Weird.
And by the way, neither can you, neither can our kids, neither can our parents.
Weird. Nobody in our family could work on it.
He could do it. That's allowed.
What?
He's not in my direct lineage.
That's weird.
Yeah.
Cool.
You cannot... So, like, let's say you're going to flip a house. You can't use the IRA to fix the house, to buy the house, to pay for all the materials, and then I do the flip. Like, it has to be like
you have to pay
total
contractors
hands off.
to.
Like, I can't even manage the project.
Oof.
Yeah. Let's see.
So you would, if you were doing this self-directed IRA investment in real estate, you would have to have a sponsor that you're hands off. They're doing all the things. They're doing all the work.
Or I could buy a house, have it be a rental, and then there's a property manager who this retirement account hires.
Right.
Right. I'm not hiring them. The retirement account is. I'm the representative for the retirement account, but ultimately it's pretend the retirement account is a third party person, like someone totally different, and pretend that it's not someone who you particularly like and you don't want them to get any benefit.
Weird.
Like that's how you have to think about it.
It's kind of a strange concept because it's like,
I know it's your money,
and if you benefit, like
the problem if you do any of this, the government goes, oh, this actually isn't a retirement account. Pay up the taxes for everything.
I guess that makes sense because it's like you're getting income.
Correct.
Essentially.
Yeah. And they want it to be a distribution officially. So you got to document everything. That's another big one. Document everything.
Well,
work with pros, document everything.
How does the government... I mean...
Okay.
It's tricky because it's
like
you're
audited,
investing.
you could get away with it, but...
And then you're getting a return back into the retirement account. Like, are you paying taxes on that before it goes into your retirement account?
Nope.
Well, like that's still income.
That's the answer. Correct, but it grows tax-free income. That's the thing.
Strange.
That's mostly true. That's not 100% true, but that's mostly true.
It seems like weirdly nuanced to me. That's like, okay, so I can't manage the place and get income.
Well, it's in the same way. Imagine you have a
retirement
retirement account, that is invested in the stock market. When the stock price goes up and maybe it sells those shares, reinvests it, does whatever, like you don't pay any taxes on that.
Mm-hmm.
It's not until you do the distribution, because you don't have any control over it. Technically, it's not your money yet. It's when you do a distribution and you get the funds. That's when, if it's a standard account, you get taxed. If it's a Roth, you do not get taxed.
Because if you were getting paid to do work, you would have control of the money. Like it would be yours.
And essentially, this is the government trying to incentivize people to save for retirement.
Yeah.
Right. So they go, hey, if you save for retirement, we'll be really nice to you on a tax basis. You can either we'll let you grow.
Yeah.
Without paying taxes, so it can grow faster. Like that's the whole idea.
Makes sense.
And then the self-directed was essentially rich people saying like, so we don't just want to do the stock market, like we want to do other stuff. And and you can see crazy returns. Like, can you imagine if there was someone who invested early on in Facebook with their self-directed retirement account, which they could totally have done. And they went, yeah, I threw $50,000 into it because I believed in Mark Zuckerberg, and now I'm worth $50 billion. Yeah. But it's all, and depending on what it is, they're either a massive tax bill eventually, or if it's in a Roth, like, boom, their kids are set for life, which could probably be a bad thing. But the next thing that they do is they do more due diligence than the sponsor does, right? So they don't just say, asset looks cool, go, right? Like you got to spend the time investing, making sure that it is. And this is not necessarily related to self-directed retirement accounts. It's just like, man, good investors, like do your due diligence, ask the questions, have the conversations, do those kind of things.
That's kind of what we were talking about. If you don't have the time to put into doing due diligence and knowing what you're investing in, just do the simple, like regular retirement, stock market,
right?
Hands off.
Yep.
Like that's fine.
Yep.
That's good. You'll get a return.
Exactly.
It won't be quite as big, but
it's
like
okay.
You'll know what you're doing.
The risk of a major loss is much, much lower, which is nice. Other thing they'll do is they stay liquid enough to strike. So they don't necessarily place all of their capital out into the field. They have some left over so that when a great deal maybe comes along, they can move fast and go, yep, I got the funds to do this, instead of being like, oh man, I got it all placed. And there's a couple things that you can do to make that work. Just straight up have cash reserves. You can have a bunch of short-term notes that turn quickly. So like we do flips, right? And a lot of these are less than a year. So you might have a bunch that are in progress. So you're like, every 3 months or so, I've got something coming up that I could choose to place into something else. Or they've got like those, again, you can start with a regular retirement account and convert it into a Roth. And so they may not do those all at once. They may stage them out over time so that they've got the funds available, but they don't necessarily have a massive tax bill all at once. And so there's games that you can play with that. So those are things that they do. And again, it's not necessarily about like what makes the 1% special isn't that they have $1 bazillion. It's just they have a strategy. They're thinking through how to do this. It's not just, I transfer the money and now I go buy stuff. Like they're really thinking through what does this whole plan look like? How do I structure this so that I can move fast, so that I can take advantage of things? How do I make sure I'm buying good deals only? How do I avoid getting in trouble? Like it's having a plan, doing the diligence. And I think it comes back to that comment that we keep coming back to, right? Like do a self-directed if you're willing to put in the time and effort to actually direct it yourself and to learn how the process works. That sets you apart. It's not just, it's another way to do it. I don't think that's how you want to go about it.
All right.
So there you go. Cool. Self-directed IRAs. That's how to be the top 1% and take advantage of this, what is genuinely a really cool investment vehicle. And as we talked about, you can't necessarily invest in your own deals because the temptation to self-deal and benefit is way too high. So my recommendation is to check us out at furlo.com. We would happily take your self-directed funds. We've got some deals where that's the case. I'm thinking of one in particular where it's a person used his self-directed IRA and invested in one of our deals as a lender even. So it's not even an equity holder, it's as a lender because that's an option. And we actually didn't do the paperwork right away, but we were able to go back afterwards and fix it. And so it wasn't ultimately not a big deal. So it's relatively straightforward once you're all set up and going. That would be my suggestion too. If you're interested, like find that custodian. UDirect is one that I like, but there's a ton of them out there. Find that custodian, get that process started so that when the deal comes along, you can move. And if you have questions about that, I'm happy to help get you pointed in the right direction. So again, you can check us out at furlo.com. And so with that, thanks for listening. Have a great day.